Okay, good morning, everyone. Hope everybody's enjoying this nice weather we're having. Gosh, I see Brenda Crosby on her deck. It's driving me crazy. I'm going to move this this Zoom session outside on your deck next time. Anyway, hey, a couple of quick things before we get started this morning here. Bring you up to speed on some of the things, some of the physical things happening here at the office. First of all, our elevator, as most people know, we had not quite a fire last week, but it was bordering on one. And we had the fire department here. We're in the process right now of getting that fixed. The elevator repair people were here. They have their part done. The next part is the electrician who's going to be here within probably the next couple of days. So that will be back active very, very soon, but I wanted to bring you up to speed. Boy, you don't know how much you miss something until you don't have it. Next thing, the HVAC system. We had one of our things blow. We had to replace a whole brand new unit. We're getting backup for that unit. It's going to take probably the better part of this week to get that finished here. I know yesterday I was in the office and we had a couple of bangings going on up the roof, up above my head. So I apologize ahead of time if there are some minor inconveniences. It's short-term pain for a long-term gain. And then yesterday, after I put out my preview video, both Janice and Marion get in touch with me virtually at the exact same time and say, Tom, your video is kind of choppy. And I don't view these videos myself. I just throw them out on YouTube and put them out to you guys. And then I went to look at it, and sure enough, there I am. I got ticks and jerks and all kinds of things going on. And I said to Marion and Janice, see how you guys have driven me over the last year and a half since I've been here. This is what it's like working with you. I've developed all these twitches that I can't now get rid of. So if you want to know what it's like working with Janice and Marion, just look at me, okay? Just kidding, ladies. All right, I'm going to share my screen. Okay. One more thing here. All right. So later on today, we're going to talk about some things that I'm hearing from agents, some agents in our office and actually outside. I've been talking to other brokers, and in fact, some appraisers that I know are really getting concerned about prices moving up. And they're saying, I'm not sure how people are going to afford these houses anymore. And people are saying, are we in for a bubble? I'm going to share a lot of stuff later on in the meeting that you can share with buyers and sellers out there, because I'm sure they have some of the same thoughts in addition to you as agents, because we're all dealing in the same market. So before we get to that, though, I'm going to have our core services talk to us a little bit about some things happening in their world. I know Dan and James are both on the call. James is, I think, on the West Coast at this point in time. So he got up early so he could make the call. Thanks, James. But I'm going to turn it over to Dan initially. Good morning, Dan.
Hey, good morning, everybody. So I wanted to talk a little bit about rentbacks. Obviously, with the current market demand, there's sellers that want to take advantage of getting their house on the market and obviously getting a buyer. And, when they're in a situation where they're maybe building a home or still looking, they're thinking, well, gosh, if I get my home on the market now, get top dollar, then the buyer essentially can let me live here and I can pay them rent to do so. So rentbacks are, definitely okay to do. There are some buyers that are willing and able to do so as well. the thing that we need to keep in mind is there is a 60-day maximum on rentbacks. And that's according to agency guidelines. So that's Fannie Mae, Freddie Mac, as well as all the government entities as well. So it's a 60-day maximum. It does need to be documented on the agreement of sale. And if for some reason it's going to go longer than 60 days, then the buyer needs to be purchasing the property as an investment property. So this is a very hot topic. I fielded some questions over this past several weeks about this. I had a situation where essentially a seller wanted to do a 6-month rent back because they were building a new home. And unfortunately, that's just not going to fly when somebody's purchasing a property as a primary residence. They would have to purchase it as an investment property in a situation like that. And the last piece of it all is that the buyer then needs to have proper insurance coverage in place. And essentially what that means is, so they're buying the property as a primary residence, so they need to have a homeowner's policy that goes into effect as a primary residence on the settlement day, but then they're also going to need to have a policy in place to cover the period where they are not living in the home. And, that's something that, obviously James, my gosh, I'm drawing a blank. James White, yes. Sorry. If you want to chime in on that as well, to provide a little more information, that would be great. But just wanted to make sure everyone was aware of that in a situation with rentbacks. 60 days is the absolute maximum as far as that.
And I know James does have, when I say James, we have two Jameses here, James Ream and James White. James Ream has something to just share with us. But before we move on to him, I just wanted to also share with everybody, not only the specific circumstance that Dan is talking about, but every once in a while I hear, as a manager who's looking either at agreements or advising agents how to put together agreements, I hear people say, well, the other agent or the other broker or the other lender told me to just keep that off of the agreement of sale, that they don't want to know about it. I'm going to tell you right now, I don't ever want to hear that. Everything that we do here at this office needs to be on agreement of sales and disclosed to people and to all our vendors, so that we don't run into a situation where it comes back in the future and bites us in the you-know-what. These things only become a problem when they become a problem. And when they become a problem, it's a major issue if you have some of these undocumented things that aren't in agreements of sale. So if in the future you come to me and say, hey, so-and-so told me that we should keep this off the agreement of sale, I'm telling you ahead of time, you know what my answer is going to be. Okay. Anyway, James Ream.
Oh, good morning, everyone. Just wanted to give everyone an update that the FHLB grant program that comes out, early part of each year, all the funds have been accounted for, so or assigned to different borrowers. So we no longer have the ability to do the FHLB grant for first-time home buyers and the community partners. I'm sure that will be back again next year. We still have, all the other programs, PHFA, LHOP, and those programs available for buyers, but this specific program won't be available again this year. So just wanted to pass that along. If you had any buyers that you were hoping to get into that, we'll have to wait till next year. So that was all I had. Thanks,
James. Appreciate it. And by the way, just a big, hand for you for putting together the Final Four March Madness poll. Apparently, I came up that short, even though I'm the only one that had the winner in the final game. I'm very, very upset. And when you get back in town, you owe me a drink.
There you go. Sounds good.
Anyway, Sarah Tompos is with us this morning, and she has a key introduction for us.
Good morning, everybody. So I wanted to introduce Alexis Mall. I know I talked about her at the last sales meeting, but she has physically arrived and she sits in my office right next to me. I know some people have popped in and have introduced themselves, but I encourage you, if you are in the office, please stop by, introduce yourself to her, get familiar with her. Like I said previously, she will be the processor here, so you guys will get emails from her. She may call you, ask you for stuff, so please get familiar with her. Alexis, do you want to?
Yeah.
She's gonna pop over.
Good morning. Some technical difficulties. Hi, I'm Alexis. I'm excited to be here. I'm definitely new to title, but I was with the Centerville office as an admin for about 2 years. So thanks for having me, and I look forward to talking to everyone.
So then I have two more things. One, as far as the March Madness goes, I want to redo because I came in last. I just want to put that out there. James is laughing at me, as you can see. So I think we need to redo all of it. And then to piggyback on what Dan and Tom were saying, as far as things being listed on the agreement of sale, just to put it in a different perspective, as the title agent, if any of you bring up any of this at the table, that, hey, so-and-so is going to pay you rent for $700 and it's outside of closing, I'm not allowed to know that. That is something that can stop closing immediately because it needs to be disclosed to all the parties involved. And that then puts, everybody kind of in a bad position. Like Tom said, if something happens down the road and it wasn't listed on the agreement of sale and it occurred at closing and I knew about it, or if Dan and James are there at settlement and something occurs, I just want to bring that up too. We can't have that. I don't know if you want to say anything further about that, Tom, but if it has to be listed and we can't know about it because it won't allow closing to continue.
Yeah, thanks. It really affects all of not only our core services, but all vendors who we end up dealing with. Even if you don't deal with the Homesale family of core services, they have the same restrictions as we do. So I know James White is, I think, on the call. I didn't see him earlier, but I know he communicated with me. James, you out there?
Yep, I'm here, and I'll add on to what the two topics that Sarah and Dan and James were speaking on as well too. One of my questions I'm always going to ask a buyer is, are you moving into the home within 30 days? And I can certainly take that second step if needed. It happens. It's happening more frequently now than in my first year. I've been here about 2 years, and I think I've done it more in the 6 months than the previous year and a half. If we have to get it insured correctly as a dwelling fire policy, which is called a tenant occupied policy, we can certainly do that because I've asked an underwriter that used to work in property claims as well too. And I said to him, "Am I being too picky here in this situation here?" And he says, "No, you certainly want to make sure it's written correctly because the buyer of the home is going to be in a real mess and a real jam if there's an insurance agent who writes it as owner occupied, and there's a situation like Tom said where it's being leased back for 6 months and the correct insurance policy isn't written. It's just going to make it a major hassle for the buyer. So that's why I always ask that question. I want to make sure everything is good for all the buyers of the home. So that's all I had for today.
Thanks, James. Appreciate it. And by the way, one thing I failed to mention at the onset of this call, Colleen is with us this morning. She's not, she's actually down in Quarryville, and she's dealing with a whole bunch of unrelated issues down there. So usually she mans the chat box. She may or may not be doing that during this call. You can still put things into chat. I just probably won't be addressing them until after the meeting when I have an opportunity to download everything in the chat box, and I can address each either question or concern on a one-on-one basis. So I wanted to let you know that also. This came out yesterday. Everybody got an email, I believe, from Rod yesterday. The Lancaster Chamber of Commerce has this side, I don't want to call it a business, a side thing called Recovery Lancaster, where they are trying to get as many people vaccinated in a short amount of time as possible. And they are now, this is what came out yesterday. At Park City Center, which I think a lot of people are aware of, there is one of the stores out there, the old stores, is actually one of these community vaccination center sites. And they are encouraging everyone at this point in time to register for an appointment, regardless of your age. I know Rod, I think today is actually going out, and Rod is underlying condition. More than 12,000 appointments that are available over the next 7 days, which is Wednesday today through Tuesday of next week. So email went out today. Somebody needs to mute themselves, please. Thank you. Wednesday through Tuesday of next week, all you have to do is click on this button in this email and it'll take you right to an appointment site. So everybody can at least get that first vaccine dose. I would encourage everybody to go there today. When I send out the notes for this meeting, I will include the link for you, so you don't have to worry about searching down that email that you received late in the day yesterday from Rod. So I wanted to make sure everybody is aware of that. And while we're talking about this subject, I mean, hopefully, I'm knocking on wood here, I'm doing everything I can. I believe we're getting to the tail end of this. However, there are still COVID cases out there that are cropping up all the time. Please, I know we've been wearing masks for a long time and everybody's getting tired of it, but please, let's see this to the finish line and continue to keep obeying all the protocols, especially while we're here in the office. And before you know it, we are going to be across that finish line. So while you're here, please, let's do everything we can to lessen the possible impact of this. Thank you.
Hi, Homesale. Are you interested in learning more about what ninjas do to generate listings for their business? If you are, please plan to attend our next Ninja Selling session scheduled on April 12th at 9:30. In that session, you're going to learn 10 proven strategies that ninjas use to generate more listings for their business. Do you think that's something you could use right now? If so, add it to your calendar, and we look forward to seeing everyone there.
So that message went out from Jen, I think Monday of this week. This is the fourth session. This is called Finding Inventory and Generating Listings the Ninja Way. And as Jen said, there's going to be 10 strategies that are shared with everybody. I think everybody would agree who's been on these sessions. We had a new, I'll call them facilitator, Chandra, the last session. Chandra was really, really good. And anybody that was on that call, I've heard a number of things from people saying that they really enjoyed her presentation style. She's going to be the final instructor on session number 4, which is coming up this Monday, April 12th from 9:30 to 10:45. It is a Zoom session, but you have to register. I will provide the link once again in the notes section. There's also going to be a link in there for handouts to download them. And by the way, just in case you want to go back to the other Ninja sessions because you may have missed them, they are all on Team Homesale. All you have to do is go to Team Homesale and plug in Ninja in the search box, and you will have the pre-recorded sessions of what we've done up to this point in time.
Dear Realtor, we heard you. You've been asking for a simplified RPR experience. So we've done just that. We've reorganized the layout on your homepage, increased the white space, the font size, the imagery. So with every login, you can just focus on what's necessary. Residential and commercial properties are now searchable from one area because, well, let's face it, a realtor should have quick access to any property at their fingertips. And to ensure faster productivity, well, we've created shortcuts to your most powerful tools. And now You can keep an eye on your market areas right on your homepage and view what you want the way you want it. And that's really what this is all about. You. Because when we're helping you live out your purpose of wowing clients and closing more deals, we're living out ours. Sincerely, RPR.
So if you might have gathered from this that RPR has changed a little bit. Actually, it's changed a lot. They've made this upgrade to the entire system recently, and I thought I'd just take a moment here to talk a little bit about some of these changes. So first of all, what is RPR? RPR is owned by NAR. It's we realtors own it. It was created by NAR, and it was created to meet the demands of our clients out there in the field. It takes kind of the MLS one step further. It is exclusive to us. I've had a lot of people ask me over the years, who has access to all this information? People are amazed when they get on there how much information is actually there. The only people that have access to this is a dues paying member of the National Association of Realtors. There's no third party public access, and every single RPR site is branded to you as the agent. So if you initially go in there and you put in your picture, your contact information, every report that is generated out of RPR is branded specifically to you. And there's no cost for this. It's part of your dues as a National Association of Realtor member. So I would encourage you, if it's been a while since you've been on RPR, please, I would encourage you to go back to the site, take a look and see what's new. I'm going to cover a couple things that they just touched on briefly in this video and highlight some of the changes here. First of all, it is a lot easier to look at. I'm an analytical person, but even RPR, the old site, it had a lot going on the homepage. And even once you dove deep into the web or into the site itself, there was a lot of things going on, and a lot of people got confused. Well, it's much cleaner now, has much more white space, bigger fonts and images as they indicated in that video. You can search all properties from one spot. In fact, a lot of people didn't even know you could search commercial properties on RPR because you had to know where the link was and go to a totally different part of RPR. They've now incorporated everything in one specific page. And it has a user-centric homepage. There's shortcuts. In a second, I'll show you my homepage. There's shortcuts and tools that are featured right on the main page, real easy to see and to find. And I can also customize something called My Market Area. So if you deal in a specific geographic area, Conestoga Valley, Manham Township, you can draw a map and circles around these areas, and you can get daily updates in graphic-oriented detail. It's pretty cool. And they also have upgraded map capabilities. So this is what my homepage looks like. Once again, much easier visually to see this stuff. And I'm not going to scroll through here. And this is not intended to be an RPR training session. All I wanted to do is share with you, it is a lot easier to look at, a lot easier to find some things. Reports are easier to put together. There's many more questions that they ask you along the way, kind of guiding you through the areas. Please, I would encourage you to get into this. You can do a variety of things with RPR, such as searching, creating reports. There's investor analysis. There's all kinds of things that you can do with RPR. And a lot of people say, well, it's either been years since I've been on RPR, or I don't even know about this. How do I get there? Here's the website. Here's the URL, www.narrpr.com. I will say this, everybody, the first time you get on here, you're going to need your NERDS number, NRDS, to register, because they want to know that you are a dues paying realtor Once again, not everybody can get on this site, just realtors. So once again, just get on the site, play around with it. I think you'll be pleasantly surprised. So I want to talk a little bit about sight unseen agreements, because we've all seen them, no pun intended here. We've all seen them. We've all dealt with them, either from the buyer's perspective or the seller's perspective. From either side of the fence, there's tons of liability on not only the buyer and the seller, but there's tons of liability with the listing agent and the buyer's agent if they aren't doing things properly. So we're going to cover some things today that you ought to be aware of if you're putting together one of these. And by the way, a couple meetings ago, I had a study, and I failed to pull it up here, but there was a study that I saw about millennials and buying property sight unseen. And we're looking at this here and we're saying, gosh, who would ever do something like this? Well, first of all, I've seen more in the last, probably 12 months than I've seen my entire real estate career being used. But millennials are looking at this totally different. Almost 50% of millennials are saying today they would consider buying a property sight unseen. So it is going to be more prevalent in the future. Hopefully, once again, this pandemic goes away, but I think there is a greater number of people that are becoming more and more comfortable with this concept. So first of all, you need to advise the buyer of all the known material defects with the property. Not that you don't do this normally, but you really, really need to pay attention. As the listing agent, the seller's property disclosure must be accurately and fully completed. Now, it is incumbent upon the listing agent to make sure this is done. I think too many times, whether it's a sight unseen offer or otherwise, listing agents are taking these sellers' property disclosures and they just throw it right into .loop and they've never even looked at it. I see this all the time, especially with when problems occur in agreements to sale, when they're brought to my attention and I say, hey, can I see the seller's property disclosure? And I look at it and lo and behold, there are blanks all over, or things not, questions not answered. As a listing agent, you need to make the seller aware that if they're missing something, you need to draw it to their attention. Next, buyer's agent should review the seller's property disclosure with their client. Don't just give them the seller's property disclosure and say, here, read this and let me know if you have any questions. You ought to be reading this yourself, making sure that you see everything that is on there. And if you see something that's out of place, you need to draw it to your buyer's attention. And finally, you need to document and follow up on all questions that arise after this thorough review, either from the seller side or the buyer side. Once again, the seller's property disclosure is probably the most key document when we're talking about a sight unseen agreement. Avoid misrepresentations in listing photos or virtual tours. And you say, what do you mean by misrepresentation? Well, I got to tell you, I've seen some really interesting photos and virtual tours in my time of things that agents do to cover up things that are visible to the naked eye if you are there. But if all you're doing is looking at the photo or the virtual tour, somehow it magically has disappeared. Resist removing anything of material substance. I'll tell you, the one thing that I see most often is people removing high tension power lines from pictures. I see it a lot where people will go ahead, they'll put it there, and then they'll have either the photographer or they will do it themselves if they know how to do it. I wouldn't know how to do it. I know how to do it, but don't do that. Resist, removing any of these things. In addition, don't overly enhance the photos or tours. I can't tell you how many times I've talked with you as agents who come to me and say, hey, I showed this property today based upon either the virtual tour or the pictures, and we got into the property. It was nothing like what the pictures look like. I don't even know where they got some of these pictures. Once again, it's okay to maybe doctor up some blemishes on a photo, but to totally enhance it over, that's a no-no, especially when you're talking about sight unseen offers, because people rely on that stuff even more so than they do in a regular walkthrough situation. And our standard of practice 12-10 requires us to present a true picture to the public. And if you're removing things or overly enhancing things, you're violating one of our standards of practice. Watch out for red flags. What do I mean by that? Well, if you're doing virtual showings for buyers who can't get there for whatever reason, as you're doing the virtual showing, you need to identify observable defects to the buyer who is that person who's watching it on this video screen. Point out to buyers and put them in writing after the showing. Make sure if you're seeing a half a dozen things, make sure not only are you bringing it to their attention, but you make notes in your file. I would actually talk with them after the fact and say, hey, now that we're through the property, remember these things that we talked about. And finally, follow up with the listing broker when the buyer wants more information. Sometimes you do these virtual showings and the buyer says, hey, can you find this, or this about it? That's great. Once again, document. It's so important to document these things in writing when you are dealing with somebody who is going to make a sight unseen offer. Avoid assuming buyer's duties. Well, excuse me. Ask the buyer to write down anything that they're concerned about. Now, we all have buyers who usually say things like, well, I'm looking for a 3-bedroom, 2-bath, 2-car garage house. But there are certain things that some buyers are looking for that you need to pay additional attention to, such as maybe traffic patterns. I have 2 small children. I don't want to be on a busy road. Make sure that you're noting that and that is a buyer's concern. Observe and report objectively. Don't, puff, which is a term that, oversaturates something, or don't reduce or minimize something either. Don't make decisions for a buyer or assume something isn't a quote unquote big deal. It may not be a big deal to you, but it might be a big deal to them. Find out more about the client that you are dealing with. Protect yourself and your clients in writing. There are certain things that you can do as an agent to protect not only the buyer, but the seller in the transaction, in addition to yourself. Ensure that the agreement of sale includes appropriate due diligence periods and contingencies. I know in today's world, we're all dealing with, should I eliminate this, this home inspection clause? We are getting to the point where I'm hearing agents say, in order to get this house, you need to eliminate that. Never suggest that they be waived. Don't go down that path. Instead, make them aware of what the pitfall might be if they choose to do it. Ultimately, it's their decision. They're going to figure it out over time, especially in the market that we're in right now, where things are really, really hot. People are going to understand and weigh those differences. Don't be the individual who says you have to eliminate that. And use appropriate disclosures and acknowledgements. As far as the buyer is concerned, we have a buyer acknowledgement. It's called an offer without physical showing disclosure and buyer acknowledgement. If you go through this, and by the way, it's just signed by the buyer. This is not something that's part of the agreement of sale. It's a disclosure that is between us and the buyer. It basically says and outlines all the pitfalls. This was put together by our legal team. And I would encourage you to use this if you have a buyer that is considering putting together one of these sight unseen clauses. And as far as the sight unseen addendum to the agreement of sale, there is specific language that you should be using. Here is some of the language right here. It says, the buyer of this property are choosing to submit and negotiate terms of an agreement without actually seeing the property. This agreement is contingent upon buyer viewing the property in person within X days of seller and buyer coming to terms with a fully executed agreement of sale. If buyer does not remove this clause in writing after viewing property, this agreement will become null and void and all deposit money will be returned to the buyer. It is further agreed that all timeframes for inspections and mortgage application and approval listed in this agreement will start on the blank day that the buyer removes the clause from the agreement. Have something like this in your agreements. Now, I'm going to take it one step further. There are some agreements that are basically saying, I'm just going to buy it sight unseen without ever seeing the property until the final walkthrough. Be very careful. I'm not saying don't do it. And I'm not here on this call to tell you and encourage you to do that. It is an option, but be very, very careful and just take heed of all the things that led up to this that we talked about previously here. Make sure you're abiding by all those things. So we're going to finish up today talking about a potential housing bubble, which I'm hearing from more and more people in our industry, and not just buyers and sellers. I'm hearing from you as agents. I'm hearing other brokers. I just literally had a conversation with an agent 2 days ago. This appraiser basically said to me, these prices are going up so much that it's going to preclude people from getting into homes, and we're going to start seeing pullback and a crash. Now, that was the appraiser's opinion. And by the way, what I'm about to review here, a lot of facts, and these facts lead us, and I'll kind of jump to the end here, they are going to lead us to the point where things aren't exactly what they were during the crash of 2005 through 2007. But I'm hearing more and more people get a little jittery. I'm hearing buyers. I just shared some information with one of the agents in the office here. Their buyer was saying, I'm not sure I should buy a home right now because I believe there's a bubble that's coming, and we're all going to be in the same position now as we were back in 2005 through 2007. We can't predict the future, obviously, and don't guarantee to buyers and sellers that what I'm saying here or what you're going to see here is, gospel, and that you ought to put all your eggs in one basket. I'm telling you, use facts so you can share with people. The situation isn't exactly the same. So let's start with this. Mortgage standards today are much more stringent than they were back just 10, 15 years ago. Now, the Urban Institute puts out a study, and they recently released their latest findings on the Housing Credit Availability Index called the HCAI. Now, this measures the percentage of owner-occupied home loans that are likely to go into default. And here was the key point that came out of their latest findings. Less than 5% of the loans today that are out there are in danger of going under. This is the lowest it's been since the introduction of this index back in 1999. So I'm going to show you what that looks like visually. You see, back in 1999, the red portion is what is referred to as the mortgage or the product risk. And the green is what the borrower risk was. And you'll see a dotted line going down the center of this horizontally on this chart that says this is a reasonable lending standard. And you saw prior to the run up to 2005, 2007, what was happening. People were getting mortgages, and mortgages were out there. And in a second, I'll kind of pull Dan into this. Mortgages were out there that you just look at today, and first of all, they don't even exist anymore, but you just kind of look at what was available and you say, gosh, how could this actually be? And look once again at the borrower risk here. Look how the borrower risk has gone down over time also. You see right now that there's very little difference between the product risk and the borrower risk. And I know Dan, once again, who's still on the call, Dan, you were in the business back in, I don't know, 2002, 2003. You saw some of this and you kind of lived through it. Can you lend your perspective on this?
Yeah, sure. So one of the scariest things about this graph is I came into the industry in 2003, just as that red started peaking, but that wasn't me. Anyway, but yeah, back then the products, I remember we had something called a NINA program, which was a no income, no asset type program, which essentially, as long as the borrower had a high credit score, nothing else really mattered other than the fact they could sign their name on the dotted line. There were bank statement programs where you essentially took a borrower's 12 months of bank statements, calculated their total deposits, divided it by 12, and that's what their monthly income was from a qualification perspective. Then, of course, there were the stated income programs, which essentially, someone said, okay, well, I work in construction, I make $60,000 a year. I think there was a website that was checked to kind of see if that salary fell into the average range of a construction worker, and that's all that was required. So, today's guidelines, as that first slide said, things are much more stringent. We do an in-depth verification on borrowers now of not only credit, but one of the biggest things, and I have this conversation often, is we have to abide by, like every lender, a CFPB guideline that's called ability to repay. And that's a strict evaluation of someone's ability to repay strictly based on their income. It doesn't matter if they have, $5 million in the bank. If they don't have a source of consistent, verifiable income, unfortunately, they can't qualify for a mortgage. So, looking at this, that green there is truly where we are today. There is, a much lower risk as far as the borrowers with the programs and products that are available compared to, back at that peak with the red. For the most part, I think that's a great thing. Obviously, there are some individuals that can't qualify for a mortgage because of these guidelines, but I think it's really going to protect all of us, especially our industry as a whole, with any type of potential housing bubble.
Yeah. Dan, thanks.
Sure.
As I said, Dan kind of lived through both eras here. He lived through the red era and then the green era. And we're in a much better position today than we were a number of years ago. So that's the first thing that I do. The second thing is, while we've had some pretty good appreciation over the past year, they aren't soaring out of control like they were a number of years ago. And once again, I'll show you some visuals here in a second. The normal price appreciation is plus or minus about 3.8%. And you will see that in the 4 years prior to the crash, home price appreciation averaged in double figures. So what's the key takeaway here? We would need another 3 years of this double-digit appreciation to be in the same position as what we were back in the day. Once again, here's what it looked like. Look at the differences between 2002 and 2005, what those appreciation rates were, versus 2017 to 2020. Now, once again, 2020, we had a very, very healthy appreciation rate. If you look at all the prognosticators looking for this year and on to the next couple of years, they're not anticipating this 9.2% across the board. So what do the averages look like? The 4-year average back in the day was over 10%. The 4-year average today is 6.28%. So we're not quite in the same boat as what we were back in that day. Homes are in short supply now versus back in that period of time. There was just an overabundance of homes, things that you wouldn't believe how much inventory was on the market. And for those of you that weren't in the real estate business at that time, our inventory just was astounding versus what it is today. So the supply of homes was literally 180 degrees different than during the market crash. Well, how does that look visually? You'll see on the left side of this chart, 2004 to 2007, and then we'll compare that to the right side of the chart. This is what it was in the run up to the crash. We got to the point in 2007 that we had almost 10 months worth of inventory that was on the market. This is obviously nationwide. Once again, look how much it increased over that 4-year period of time. Now let's take a look at today and what it looks like today. We're in, as the previous slide showed, a 180-degree difference from what it was back then. We are, as a country, we're at 2.1% as far as our not percent, 2.1 months of inventory versus what we were, once again, back in 2007. It is just totally different. New construction has also played a key role. Some of the figures I'm going to show you here come from the United States Census Bureau. The new construction has always been a leading indicator of how the economy is going and how things are doing, especially in the real estate business. What has happened right now? Our country has had 13 straight years of completed units below the 50-year average. So there hasn't been a lot of new construction that has been pumped into our economy and inventory levels. Once again, let me show you what it looks like visually. Here's from 1970 to right before the crash. You know, sometimes we were a little above that average, sometimes a little below, but look what happened in the run-up. We had 4 consecutive years of record-setting number of units that were just pumped into it, which if we go back to one of the previous slides, that's what accounted for that 9.1 months worth of inventory. Now let's take a look at where we were or where we've been over the last 13 years. Look at this, just a little bit different than what we were in the run-up. Now we are gradually increasing, as you see here, which by the way, I think is a good thing because we are still below the average annual units that are completed level. So overall, this is a good thing. This bodes well for our economy. And oh, by the way, for those of us that are really concerned about the inventory shortage out there, I'm seeing and hearing more builders that are getting ready to start projects and put things into our system. So it's a good thing for all of us. Number 5, despite a rise in prices, houses are still affordable. And this comes mainly from this appraiser that I heard, which they will remain unnamed. They basically said these prices are getting way out of hand. Nobody's going to be able to afford these homes. It's really not a true statement. Affordability, as you see here, a formula, which I'm not going to get into here, really has to do with 3 different components: the price of the product, the wages that people make, and where are mortgage interest rates. Where prices are and where this appraiser was focusing on was only one of the components. The average homeowner today uses less of their monthly income toward a mortgage payment than they did 15 years ago. Even though prices are higher, 15 years ago, interest rates were at, if anybody remembers this, 6%. Today, they're hovering just about a little over 3%. So it's half of what it was 15 years ago. How does that look? Well, from 85 to 2000, here's the percent of median income that a person needed to purchase a median priced home. You needed about 21, 22% of your income. In 2006, in the run-up, and then the ultimate crash, here's what happened. It increased to 25%. And once again, if we put all those components together, the wages, the rates, the prices, this is where we stand today. We're only at about 15%, which is almost 10 percentage points below where we were in 2006. People are in a much better position with the homes that they own today than they were 14, 15 years ago. And a final point that I'm going to bring up here, in the run up, I'm telling you, everybody, and when I say everybody, a large portion of people use their home as an ATM machine. They basically got into the home and then started pulling money out with home equity loans and doing all kinds of things that really added a lot of risk and added some things that really shouldn't have been added to our economy. Here's where we are today and why it's not like it was back in 2006, 2007. 50% of the homes in the country today have at least 50% equity in them. That is a far cry from where we were 10 to 15 years ago. It's not even close to where we were 10 to 15 years ago. So even if the economy kind of levels off or dips a little bit, people still have close to 50% equity in their homes. They're in a good financial position. So here's what this looked like as far as refinance was concerned. This is the total number of dollars that were refinanced in 2005 through 2007. And you see the dollar figures there. 263 B for billion, 321, 240, add that up in 3 years, he had 824 billion that were refinanced, almost $1 trillion. Well, here's what happened. You started getting into negative equity, and negative equity led to foreclosures and short sales. And when you had these foreclosures and short sales, what happened then? All these developments, and I lived in a development, to be frank, that I saw homes around me that were distressed in short sale or foreclosure. And I looked at the value of their home and I'm thinking, I was fine, but those homes affected the value of my home. So it discounted everything in the marketplace. So basically what happened, prices tumbled. Everything started going downhill, and they went downhill in a big way. Here's where we are today as far as refinance is concerned. Look from 2018 to 2020, nowhere near the figures that we're dealing with back 10, 15 years ago. What does that equate to? You saw the previous slide where I said that approximately 50% of the homes in the country have at least 50% equity. This is what it translates into dollar-wise. The average home equity today in a home is $190,000. $190,000. Nowhere near where it was back in the day. Okay. So I've just shared 6 things with you of things that weren't the same years ago as they are today. Are there some things that we need to be concerned about today? Absolutely. I mean, we're all experiencing it today. You saw the one graph that I showed you here that last year on a nationwide basis, we had 9, close to 10% appreciation. Everybody feels good about that when they own a home until things crash. I'm okay with that in 1 year or 2 years, but you string together a number of years, and then I start getting concerned about it. So overall, I call it the turbulent waters of 2006, 2007 shouldn't return anytime soon. Now, is that a guarantee on my part? Please don't anybody walk away from this session and say, Tom said, and guaranteed that nothing's going to happen over the next blah, blah, blah. It's not what I'm saying. I'm just saying all the things that we're dealing with in this industry, or many of the things that we're dealing with in this industry as key indicators, just aren't the same as what they were years ago. And I'm going to leave you with this quote. Pressure is something you feel when you don't know what the hell you're doing. That comes to us from Peyton Manning, a Hall of Fame quarterback. And I kind of liken it back to, some of the things that we talked about here. When your buyers and your sellers are quizzing you about, hey, are you afraid of what's going on in the economy? Once again, don't guarantee anything, but show them some of the things that I just showed you here, where things just aren't the same as what they were back during the last crash. That is pressure. But if you have the knowledge up here to share with your clients, it's not as much pressure on you. In addition, we talked about sight unseen, agreements of sale, and that can put pressure on buyers and sellers. It can put pressure on if you don't know what you're doing. Make sure that you're covering all your bases, crossing your T's, dotting your I's, and taking as much liability out of that as possible. Because at the end of the day, in the market that we're in right now, that's very, very fast moving, we need to be doing things the right way, crossing T's, dotting I's, doing everything. In this fast moving market, we have a tendency to get away from some basics, and we don't want to do that. And, hopefully we highlighted a couple of things today. That's all I have for you today. We're right before 12 noon. I hope everybody has a great day. Once again, if you drop things in the chat box, just as a reminder for you, Colleen may not have been able to get to you today. I'm going to respond to anything in the chat box after this meeting. And you saw some valuable links at the beginning of this meeting. I'm going to put them out in the notes for everybody to have. Hope everybody has a fantastic day. Enjoy.